if we were to sort of put up a list and say, all right, you've got China and trade, you've got the Fed, maybe you throw in Brexit, you've got technicals, is there one thing you could point out that would be maybe the most important thing to U.S. equities right now?
Well, we always look at markets through a technical lens, and obviously we have incredible volatility right now with all these headlines, right? I say these days, everybody has a trade plan until they get punched in the face by a tweet, right? I mean, we saw this again on Friday. Now we see it with this news program. When I look at all these things, though, including the Fed, if you look at the larger market structures, they keep following patterns and a path. In July, we talked about a sell zone into 3,000, 3,050, and markets built this large megaphone pattern, and we rejected clearly from there, and we're still in this consolidation range that we've been on for the last few weeks. So markets are negotiating here in terms of a battle for control.
Deserve is probably the wrong word, I guess, Sven, but it's 5:16 in the morning. I guess I'm struggling to find a better word. Do the markets deserve to turn around nearly 400 or 450 points in the matter of 90 minutes this morning based on the comments from the president about China perhaps wanting to come back to the table? Should trade headlines move markets like this?
Very good question, Brian. Look, there's a lot of emotion in these markets. The markets clearly are sending a signal here. They don't want an acceleration in the trade war. They don't want a deterioration, because basically what we're looking at is, I think everybody's playing with fire here a little bit, because we have 8, 9 global economies at the verge of recession or in recession. And so you're worried about a trigger that can push things really into this recession territory. And I think what we're also seeing here is the U.S. reacting to downside pressure in markets. We saw this in August when we had this first escalation in terms of the tariffs. They will then walk back, as you recall, with the tariff delay, and we immediately had a relief rally. And of course, on Friday, futures dumped again into overnight last night, and so we immediately see a walk back again. So I'm going with Occam's razor here, which is the simplest explanation is often the best one. And we see reactions when markets drop hard. We see the walk back, and obviously this is where algos and traders are reacting very, very quickly, because ultimately it sends the message that maybe everybody's aware that they are playing with fire and they don't want to risk a global recession to unfold.
I look at your charts and I look at some of the key numbers that you follow, Sven, very closely. And it does appear, though, and please correct me if I'm wrong, that, yeah, we are popping this morning on those headlines, but the market internals, when we look at whatever sort of technical thing that we're going to look at, do appear to be weakening.
They have been weakening for a while, especially when looking at the value line geometric index. But most of all, more importantly, from a trend perspective, we actually broke the 2019 uptrend in the last couple of weeks. We tried to recapture it, and I would assume that this rally here in this counter rally is trying to recapture it again. But we've been in a very precise consolidation phase, very much similar to what we saw last fall. Last fall, we had several weeks, a couple of months actually, of back and forth. We've seen exactly the same thing now. If we break out of this consolidation zone to the downside, then we have further risks, obviously, to the downside with volatility rising. So markets have to negotiate a lot of uncertainty here. And as we see from day to day, there may be a trigger up or down. So watch very carefully the recent lows at 28.20. If we should break below that on a confirmed basis, then we can head back to the June lows into the 2700, 2750 range.